happens if I lose my job and can't pay my mortgage? If you lose your job and you can't pay your mortgage, the most important step is to contact your lender immediately. Many lenders have assistance programs or hardship forbearance options that may allow you to pause or reduce your payments temporarily while you get back on your feet. Ignoring the issue can lead to missed payments, late fees, credit damage, and eventually foreclosure if the loan remains unpaid. Depending on your financial situation and the policies of your lender, you may qualify for options such as loan modification, repayment plans, or government-backed relief programs, especially during times of economic crisis. It's also wise to explore unemployment mortgage assistance programs offered in some states. The key is proactive communication. Waiting too long can severely limit your options. How does property tax affect my mortgage? Property taxes are typically rolled into your monthly mortgage payment if you have an escrow account, which is common for most borrowers. Your lender collects a portion of your estimated annual property tax bill each month and pays the tax on your behalf when it's due. This simplifies budgeting, but also means your monthly payment can fluctuate if your local government raises property tax rates or your home is reassessed at a higher value. If property taxes increase, your escrow payments will go up, and your lender may perform an escrow analysis to adjust your monthly mortgage bill accordingly. For those who don't have an escrow account, property taxes must be paid directly by the homeowner, which can be a significant lump sum cost once or twice a year. What happens to my mortgage if I sell the house? When you sell your home, your mortgage must be paid off at closing. This means the proceeds from the sale will first go towards settling the outstanding balance of your mortgage, including any fees or penalties. If your home sells for more than you owe, the remaining profit is yours to keep. However, if the sale price is less than your mortgage balance, a situation known as being underwater, you may need to negotiate a short sale with your lender, which requires their approval and could negatively affect your credit. Most traditional mortgages are not tied to the property in a way that carries over to a new owner, so the debt is fully satisfied when the property changes hands. Can I transfer my mortgage to someone else? In most cases, mortgages are not transferable. However, a few exceptions exist with what's called an assumable mortgage. Certain government-backed loans like FHA, VA, and USDA loans may allow a new qualified borrower to assume the mortgage, meaning they take over the loan's terms, balance, and interest rate. This can be beneficial in a high interest rate environment if the original loan had a much lower rate. That said, the new borrower usually must meet lenders' qualification standards, and there may be fees or paperwork involved in the assumption process. Conventional mortgages typically don't allow assumptions unless the lender specifically agrees, which is rare. Always check your loan documents or consult your lender to see if your mortgage is assumable. How do interest rates impact my mortgage? Interest rates are one of the most significant factors affecting the size of your monthly mortgage payment. When you have a fixed rate mortgage, your interest rate is locked in for the life of the loan, and your monthly principal and interest payments remain the same. However, with an adjustable rate mortgage, otherwise known as an ARM, your interest rate and therefore your payment can increase or decrease over time depending on market conditions. Even small changes in interest rates can result in large differences in monthly payments and the total amount paid over the life of the loan. The higher interest rate increases your borrowing cost and your monthly payment, while a lower reduces both. That's why securing a favorable interest rate, ideally when rates are low, is crucial when applying for a mortgage. What if my home value drops below what I owe on my mortgage? When your home's market value falls below your outstanding mortgage balance, you're said to be underwater or in negative equity. This can be problematic if you need to sell the home, as you may not receive enough from the sale to pay off the loan. In this case, you might need to negotiate a short sale with your lender or bring cash to the closing table. Being underwater doesn't automatically mean you're in danger, as long as you continue making payments on time. However, refinancing or moving becomes more difficult. Some homeowners choose to ride out the market and wait for home values to rebound, while others explore government programs that help with underwater mortgages, depending on eligibility. Do I need homeowners insurance and what does it cover? Yes, nearly all lenders will require you to carry homeowners insurance as part of the mortgage agreement. This insurance protects your home and personal belongings from damage or loss due to events like fire, theft, storms, and certain natural disasters. It also includes liability coverage in case someone is injured on your property. Now, your lender will want proof of adequate coverage to ensure that their investment is protected and that the insurance premiums are often paid through your escrow account as part of your monthly payment. It's important to review your policy annually to make sure your coverage remains appropriate, especially if your property value has increased or if you've made upgrades to the home.